We did it, guys. We beat the market. Despite a shaky end to the year, we managed to carry our gains forward all the way across the finish line without blowing our massive lead. Even after a little bit of underperformance in the last few months, our final score is a solid 19.65% return for the year, which is 7.3 percentage points higher than the market return of 12.35%. In this video, I'm going to do a post-mortem analysis of the last year of investing, looking at all the picks, the main decisions that defined the year, as well as what lessons I've learned from them. And trust me, there are a few. So without further ado, let's take it from the top, stock by stock. First up, I'm just going to bundle together all the boring ones to get them out of the way, and then we can take the juicier ones one at a time. CAA, SRG, BFL, all of these are great stocks with strong balance sheets and earnings, and I wouldn't change anything about my strategy with these three, except to maybe experiment with more actively trading some of the volatility. Despite generally just going up and to the right for the whole year, all these stocks saw massive swings towards and away from fair value, and if I was more actively scaling my holding based on distance to fair value, I could have potentially picked up some additional income off the volatility. But for the most part, they have performed exactly as I hoped they would, as set and forget stocks that I don't have to worry about or rethink every quarter. Stay awesome, you guys. Now for some of the more colourful participants. BIS Alloy Steel was one of my first picks for the new portfolio. I think it might have been the second stock I picked for it, out of the initial 8 or however many there were. And I sort of held it for a short while, and it pumped rather quickly, and I sold it for a 20% gain and called it a day. At the time I said that the reason for the pump seemed to be some speculation that they were about to get a massive submarine contract, which at the time I called baseless speculation, as I hadn't really seen much evidence that this was something that was coming down the pike. So I just took my 20% and left, figuring it would go back down when the speculation died down, and maybe I could get another 20% then. However, I really should have done some more digging, as they have actually been advancing through the qualification process for this massive submarine contract, and in the time since I sold, it has actually doubled. Which means that compared to my entry price of $2.05, it went up by 120%. If I'd actually put in some extra research and seen this deal coming, the gains from this stock could have been more than the gains from the entire rest of my portfolio combined. So I'm a little bit salty about that. And it really does just come down to not being so lazy and putting in some extra research. A lesson that's also been taught to me by some of my other stocks this year as well. Which brings me to ORA, but, well, I've already gone over the ORA situation in detail in previous portfolio reports, so I won't bother rehashing it here. But suffice to say, I got lazy, I didn't stay on top of my research, and I got punished for it by having a 15% gain wiped out off the back of a bad report that I could have easily seen coming. The next two stocks I'm mentioning together because they sort of fall into the same mental bucket for me, in that they've both sort of taught me the same lesson. Despite the fact I actually made money on Hum and broke even on CRM, I consider both of these companies to have been sort of a mistake, or at the very least I would have traded them very differently if I knew back then what I know now. The problem with these companies is that they are perennial overpromise underdeliver type companies. It always looks like the next report is going to be the report where they finally turn it around, and then when the next report actually arrives, something's gone wrong or they've found some excuse to why they've put out another set of bad numbers. They bait investors into thinking the turnaround is imminent, but the constant surprises mean it's always just out of reach. People often talk about the importance of good management when picking companies to invest in, and for most of my life I didn't really understand what they were talking about. Management is not something you can put into a spreadsheet, and even if I look up all the resumes of these people individually, it's not like I myself have the expertise to vet their qualifications and experience. Instead, the way I've learned to look at management is asking the questions that you don't need domain expertise to answer. Are these people trustworthy? Are these people working for shareholders or themselves? I've read a lot of financial reports, and while I still definitely get fooled from time to time, I've started to be able to tell when companies are being dishonest with investors. One of my favorite games is playing Spot the Difference between the financial report and the associated investor presentation. In the report, they are forced by the ASX reporting standards to put in all the grisly details. If you've already read all the grisly details, it can be very interesting to see which pieces of information conveniently don't make it into the glossy investor presentation. As for whether they're working for investors or themselves, you can tell a lot about that by looking at their capital management strategy. Management who make the company bigger for the sake of it, mergers, dilutive acquisitions, capital raisings, and at the expense of shareholder value, are a big red flag. If you have an underperforming asset, often the best thing for the shareholders is to sell it off and return the capital to the shareholders. However, that makes the company smaller, and a selfish management team doesn't want to make the company smaller, because it shrinks the well that their paychecks are drawn from, and because presiding over smaller companies affords them a lot less management cred than presiding over larger companies. For the record, I'm only putting Hum and CRN into the deceptive investor relations basket. I'm not trying to badmouth their capital management strategy. I haven't talked about any companies with questionable capital management strategies because I haven't bought any. You could potentially debate that ORA falls into this category because their acquisition was definitely debatable, but I am always laser focused on earnings per share, so you're generally not going to catch me following companies like that. With Hum and CRN both, I just found that the way they presented their company to investors at least a little bit dishonest. I covered Hum's reporting practices in great detail in one of the portfolio updates. In future, I plan to keep more distance from these sorts of companies, or at the very least add some extra discount to them in my valuation model to compensate for their results being presented in an overly rosy manner. The next stock on my 2024 retrospective is Big River Industries. This stock was down massively at the end of the financial year, as they had recently put out another set of disappointing numbers. I was clearly way too early to the party on this one, and I could have definitely waited longer for it to find a bottom before going in so damn hard. I was so excited to buy the downturn that I bought before the downturn had even happened. Since I picked the bottom on Tamerwood so successfully, I thought it would be a simple matter to do the same for BRI, because they're in the same industry. But it turns out that it takes at least a year for the crisis to propagate up to the next level of the supply chain. This has been a valuable and expensive lesson, with the portfolio being down over $7,000 on the BRI purchase. On the bright side, it's already rebounded slightly from the low it was on at the end of the financial year, so BRI is going to look like a profit on my charts for the whole next year and pump up my numbers. MME I am not going to talk about because it didn't really do a whole lot during the financial year and has done some very exciting stuff since the financial year ended, so you can look forward to that in a future video whenever I get around to making that. And finally, the last stock on the list is Tamerwood. This was a classic case of picking the bottom of a bust recovery cycle. I managed to fill my bags with Tamerwood stock not too far off the bottom and sold the whole way up as it pumped towards $3. The only thing I could have done better here is buying more, as it turned out to be basically a perfect trade. Now, you're probably thinking, what do you mean Tamerwood is the last stock on the list? You haven't talked about MGL yet. Well, MGL has done some interesting stuff, but one, none of that stuff happened before the end of the financial year, and two, that interesting stuff is still playing out, and I haven't really figured out what to make of it just yet. I'm going to discuss it further down the road when I have a better idea of what's going on and its implications. So yeah, that's it on a stock-by-stock basis, but just to summarize, I'm very happy with how I've performed as an investor this financial year, and the most important thing is that I actually learned a lot this year, more than I do in most years. And I think part of that is to do with the fact that I've been putting all my decisions under a microscope by making these videos. It's really helped me refine my strategy and think a lot more actively about what I could be doing better. That alone is reason enough for me to keep making these videos into the future, but it might be a little while before I make the next one. That's not just because I've been spending all my time on Polymarket, it's mainly because the script I wrote to make all these snazzy charts needs to be rewritten somewhat to support multiple financial years. And I have really not been in the mood for programming, so I've been putting it off. Between updating the script and actually making the episode, it could be another few months before you hear from me again. But who knows, we are in the thick of reporting season right now, so maybe there'll be some fireworks that will inspire me to get my shit together. In case you're curious, I'm currently closing in on 8,000 USD in profits on Polymarket, or like 11,000 Australian, in 6 months. I'm very happy with how it's been going, and for that matter, very happy with how the portfolio has been going, and I'm excited to see how I can perform in this new financial year. As always, thanks for watching, and I'll see you in the next video.